Okay, very good morning to everyone. I'm going to start. It is now 8:30 in the morning. Today is April the 16th, 2022. Uh, can I just do a quick sound check, please? If someone can just unmute and say hello. Happy
Hello,
Easter.
Sam.
Hi, who is that?
I'm here. I'm here.
Who's here? Zhang Ge. Okay, is that Zhang Ge? Was that you? Sorry, I missed it when someone spoke.
Yes, I am.
Okay, good
I'm
morning.
talking to you now.
How are you?
I'm fine.
Okay, now thank you everyone for joining us. It's good to be here. And a few things I want to update you on. First of all, can I just get an idea? Does anyone have a class starting at 10 a.m.? Is anyone having another class starting at 10? Is anyone going to be busy from 10 a.m. onwards? In other words, not this week. Okay, thank you. If I just go a little overtime, it'll be okay with you because I don't know. It depends on how we go and whether you have lots of questions and stuff. But I want to. I go for quality in front of quantity. So I want to make sure everything is properly covered. All right, but if I go overtime and if you have to leave early, don't worry about me, okay? And I will try to make in that case, I'll try and make the video available later on. Now, what are we going to do this week? This is your last session before your midterm. I hope you are aware of that. Just by way of housekeeping, you have you will be getting you will need to start doing your second assignment quite soon. But for now, I think the priority is to prepare for your exam. There is no class today, and I want to thank you for logging on. I am aware that technically today is a public holiday, at least in Hong Kong. This is the Easter weekend, so it's one of the rare long weekends here. So I want to thank you for joining me. I didn't want to break the rhythm. I didn't want to break the schedule. Given that in 7 days you will have a midterm exam, we really should meet one more time. And then I'll say a bit more about your group project in a moment, and also your midterm. So here's the calendar, and we are kind of right here just before halftime. And so there's a little E here, as you can see. So this is when we have the midterm next week. It's going to be in the afternoon, starting at 2:30 for everyone, both FA and FC class. And then after that, we have 5 more meetings with Ruben. And, we have 5 more meetings here. And then we say goodbye to each other. Now, I'm sure you have received the advice from our department that the rest of this term or the rest of this academic year will be conducted or delivered in online mode. If you didn't know, well, you know now. Okay. So I don't know. I think looking at it from your point of view, from the logistics point of view, from the convenience point of view, it's certainly good news. So if you were outside of Hong Kong, then now you don't have to return. I get that. I understand. But for me, it also makes me a little bit sad because it means that I won't, or we will not be meeting in classrooms anymore. That's the way I saw it. That's the way I see it. But never mind. Okay, just sharing with you what I think. And then, Fran, I'm going to have to mute your microphone if you don't mind. I hear a little bit of background noise. Okay. Now, here are the links for lectures up to the most recent one, which you can find in Blackboard. If you don't have, if you are unable to access, or if the links don't work, do let me know. I'll fix it right away. And if we need to put so today we are in 5T. There was a previous session 3-4 days ago, and I think I also, this is the link for that. Okay, so later on, if you want, I will put today's link in there as well, because today, I think it's not really necessary to provide the video of every tutorial, but today it is meaningful because I'm going to answer the remaining questions that were sent to me and by one of your classmates. And the more I looked at it, the more I thought, wow, this is just excellent revision material in preparation for the midterm, and just also as a comprehensive review from the point of view of somebody who read the notes very carefully and then picked out the bits and pieces that maybe we could have expressed a little bit better. Okay, so we're going to do that now. For the financing proposal, so you have all the teams, and we will be doing the presentations during the last 2 weeks. So there are 8 teams. We're going to get four teams in the second last week, sometimes called the penultimate. So the penultimate week. Penultimate means second last. It's just a penultimate week, and then another 4 teams for the last week. Now, for your group project, I do need you to let me know what company you want to focus on. Okay, and last week I already showed you what people did in the past. It doesn't mean you have to copy, but just to give you a template to get you started. Okay, but we would like you to know what company you plan to work with, and you can just go to the Google sheet. And I see that no one's done it yet. Whoops, unfortunately. So what you need to do is just put down your class and what is your team name, what company you want to cover. Let's just say it is Apple Inc. Then the stock code will be AAPL. I never knew why Apple is it should be APPL, don't you think? But it's not. It's AAPL US, for example. Okay, that's it. But I need you guys to shift up 1 year and get this organized. The key reason is we don't want people to overlap. There's like 3 million companies in the world. I mean, there's no reason why 2 teams should work on the same company. Okay, now we do have some guidance for you. In your interest, we would prefer that you pick a company that has an international listing and participation in global financial markets. Otherwise, it's going to be quite hard for you to apply a lot of the concepts that you have learned so far. Okay, and credit rating and IPO, standard market procedures, green shoe, and clawback, all of those things. It would be quite hard, and primary, secondary listing. So please try to do that. Please help me, so I don't have to keep chasing you. Of course, I mean, if you want to work on a company A for Apple, then if you put that down first, then you will get it. So it is in your interest to have to get that first mover advantage. Okay. Now, regarding the midterm coming up, it will be next Saturday afternoon. Please, you have to log on to Zoom. The standard procedures. It's going to be 2 hours. There will be short questions and some multiple choice. It is open book, but it doesn't mean you can use social media, email. No. Okay, you can refer to your notes, and that should already be sufficient. You really don't need anything else. You're not going to be able to Google for an answer. There are general online protocols, and I think because all of you have worked with me. The protocols are: you're going to need a computer. I do not mean an iPad. I mean a computer. So either a laptop or desktop. Not an iPad. Not a phone. Okay. You do need a phone, but a secondary device. But that is for Zoom online monitoring purposes. Okay. I'm going to record the whole thing, and do not be alarmed when I zoom in and zoom out. We do that. Okay, and it's nothing to worry about. Just carry on with your exam, but do arrive early and set up your camera properly. You should really just have your computer. If you want to have some notes, that shouldn't be a problem. But you should organize your workspace in this manner, not like that. I can't see what's going on. I would hate to disturb you for such trivial reasons, such as your camera angle. And then what else? Yeah, don't do this. I can't see what's going on. Now, I see that some people have, sometimes they turn on 2 cameras. Okay, fine. But that just gets me a little bit confused, because I would then think you haven't got the other camera turned on, which is this. This is the essential one. If you got another one, fine. It's good to see you twice. But remember, I am always looking for this, what I call the 4:30 angle. And 4:30, because if it's 4:30, then it's from this angle, isn't it? That's 4:30. Now, and then what we'll do is you need to make sure that you are contactable at all times, and I would advise you to turn on your speaker, turn off. Now the microphone is easy because I can mute the entire chat room, so you don't have to worry too much about that. But I cannot turn on your speaker. except by making a request. Okay, so you do that, and then if there are any announcements, if there are any typos, and I hope there are not, I hope there won't be, then we will make an announcement right away. Okay. Use the keyboard, please, and answer questions for the entire exam. So the questions will be displayed within Blackboard, and the answers have to be typed into Blackboard. You shouldn't have any kind of social media or email, Instagram, Facebook, that kind of stuff. No. Okay. And you should stay at your desk at all times. When the exam is finished, then it will shut down by itself. There's a timer on it. It will shut down exactly 2 hours after you start, and it will auto submit as well. I recommend that you do stay behind just for a little longer, no more than 5 minutes. I'm going to just check that everybody has submitted their files. Okay. And one thing to remind you, which you should know, which is you should answer a question first before moving on to the next one. Okay? And I mean, you know that, because there's no backtracking. Okay, this is to just further reduce, it's actually for your protection. Okay, collectively, is to reduce any prospect of collaboration or academic misconduct if two parties want to help each other, and then if you have that backtracking function, then you can. Okay. Oh, what is the answer to this question one? Although all the questions are actually randomized anyway, so your question one is somebody else's question 17. Okay, but still, answer a question before you move to the next one. Okay, make sure your internet is stable, and you will have to finish in the allotted time. Okay, is everyone okay with that? Are there any questions from anybody? All right, if everyone's happy with that, now let me go to, and please get this taken care of. I would be so grateful. I'm just gonna stop share for a moment. If you want to ask me questions this morning, so don't be shy. Okay, so share screen again. Now I'm going to just quickly go through. As you recall, we were doing this. We were in the middle of doing this last week, and we actually covered questions 1 on bank capital and question 2 also on bank capital. What is the general provision? What is it there for? And well, why is it that there is a limit to it? Okay, why is it that you cannot just keep piling up your losses or your potential losses in the general provision account? So we talked about all of that in quite some detail last week. We did this as well, the callable AT1 bonds, and what does the step-up coupon, what does it mean? What kind of signal is it actually sending to investors? And why is it, importantly, why is it that so you can issue just the the standard perpetual bonds, perpetual bonds, the standard perpetual bonds, and these often have core features, perpetual, perp, and then non-call 5 years. And after 5 years, they can be called. Now, and then there are these AT1, additional tier 1. So first of all, this is a class of instruments that you will only find with bank issuers. They're only issued by banks because it is part of the requirement or one of the innovations, I should say, that came out of the global financial crisis, that banks are able to issue AT1s, specifically contingent convertibles, and these were like a grand compromise, I suppose, between shareholders and the banking industry and regulators, locked up in a triangular relationship. And COCOs do not have coupon step-ups. They're not allowed, and we explain why. So I'm not going to repeat on that today. It's sending a different signal to investors and to regulators that, hey, because there is no step up, we have less urgency. You can look at it two ways. We have less incentive or less urgency to call it back after 5, 7, 10 years, because the financing cost doesn't change. Okay, so that's really the intuition behind it. Now, that's where we got up to, amongst other things last time. I'm gonna have a look at this one, question 4, and I'm going to take it from here. Because of the lockup period, the cornerstone investors suffered losses from the deal of Kuaishu. May I ask if the cornerstone investors are allowed to buy puts to hedge in reality? Yes, I think they are. Now, but I think, if you ask a question like this, you are assuming that there is a market for put options. So potentially, and you can actually go to the Hong Kong exchange and check whether there are exchange traded. So Hong Kong, the equity market does have options, but is not known for being incredibly liquid. They're certainly not compared to the United States, for example. So there can be exchange traded, but I wonder if a stock is so new, whether you are even going to get an option market, even if there is one, and I question that. It can be, you're going to need time for the IPO to settle down and for prices and volatility and so on. Of course, the second thing is you could go to Morgan Stanley or UBS and say, hey, do you want to make me a market on put options on Kuaishu? And they probably will, but typically these can be quite expensive. Okay, but there's nothing to stop you really going to a third party quietly and do things. I want to tell you. So while we're on that subject, okay, the subject is, can you do things sometimes outside of the exchange in a way that may be sort of undetected. There was a very famous case some years ago, and you can find information on that, I think, on the internet. Louis Vuitton, the full name is LVMH, Louis Vuitton Moet Hennessy. So they're actually as you know, they're a luxury brand, one of the biggest in the world. And for a long, long time, they wanted to buy Hermes. So and Hermes was a much smaller and highly protective sort of family business. I mean, a lot of European brands are run like that. Just started with very humble beginnings and of craftsmanship, and then it just grows and grows. But now, of course, there are laws, and you have to look them up exactly what they are in France. But there are similar laws regarding, if you go to the stock market, all right, and if you buy too many stocks of Hermes, then you have to make disclosures, and you have to tell the regulators, you have to tell the market, and there may even be some prohibition on how much you can buy and stuff like that. It's mainly to protect the small investors. And when you buy a lot of stocks of certain companies, so that company starts to get really quite alarmed. You look at what Elon Musk is trying to do to Twitter, for example, right now, and it's all over the news. Okay, and how Twitter is now feeling a bit nervous that they might be taken over. But anyway, in this case, in this famous case, what Louis Vuitton ended up doing, they went to some iBanks, and they actually paid money to buy call options on Hermes. Now, like I said, it just so happened there's no rule against doing that at the time. That there are no rules saying you cannot buy a ton of derivatives and synthetics voluntarily, and they did that. And then these call options, if they expire in the money, it's physical settlement. So it means that Louis Vuitton will actually end up getting a lot of shares delivered to them. And of course, when Hermes heard that, they got really upset, and I think they took LV to court, and you can read all about that. So it's an example of sometimes market participants using alternate methods to arrive at their purpose. All right. So let me get back to this one here. There's a question in the chat box. What kind of questions will be in the exam? Well, how do I answer that? There are two sections. There is the multiple choice. There are short questions. Okay, I think you can divide them into maybe three categories. Category one would be concept questions. Okay, And we've been talking concepts, for the last 4 or 5 weeks. Green shoe and clawback and primary versus secondary and all of those things. Okay, and in fact, we are still talking concepts this morning. Okay, the second category would be some very simple calculations. Calculations on anything. Any slide that you have in your lecture notes. Excuse me, with numbers on them. Okay, potentially it can be a calculation question. The third type would be, what I call case studies. Case studies. So we give you some information, or we give you a passage, and if you want a clue, then just look at what we asked you in assignment 1. That gives you an idea. So the style, there is some similarity, so that style can repeat itself. Okay. Yeah, so these are the questions that will be asked. Okay. Now, can you kindly? Yes.
Can we refer to our iPad to iPad's notes? Can we during the exam?
Can you refer to your notes on iPad?
Yes.
Yeah, but we have to be able to see your iPad. Please don't use your phone. Okay.
Okay.
You get very nervous if you start Googling and if you start chatting with your friends on the phone. It's probably we would prefer you to use computer. But if you use your iPad, we need to be able to see it. You cannot turn around and then tap on your iPad and then come back. I mean, we do notice these things. We pick up a lot of your behavior, a lot more than you realize. Okay.
Okay, thank you.
You're welcome. Okay. Now, question 5. So I'm going to talk. I'm going to speed up a little bit. Thank you for that question. Can you kindly explain holding company discount? Does it mean the holding company usually has comprehensive business and less liquidity? So investors are only willing to buy stocks if the company is offering a discount. Not exactly. Not exactly. You have to. You have to understand. You have to understand. I have written some notes. Now, first of all, what is a holding? What is a holding company? Okay, a holding company is like this. So, and take our old friend HSBC as an easy example to understand. So there's HSBC holding company limited. Now, when you buy shares of HSBC, you are buying shares. For that again, you are buying shares of this entity. So this company has a balance sheet. It is HSBC holding company limited, and it has, and in Hong Kong, as we go by numbers, it's number 5. Okay, 5號仔. Okay, wow. So that is okay. What does this company do? Okay, now the answer is not a lot. So the way it works with a lot of conglomerate structures, not just HSBC, practically all the big organizations you can think of, they work like this. So down there, there's the bank, which is everywhere, HSBC. And in fact, the bank, maybe it can be divided into HSBC Greater China, HSBC Europe, HSBC UK, HSBC Americas, and so on. But we will not go down to that level of detail. And then there can be HSBC, let's say insurance, okay? There can be now typically the asset management arm is also a separate, independent, as it should be, okay? And you may even have, let's say, HSBC private banking, because quite often these are incorporated in Switzerland, okay? Swiss, S-U-I-S-S-E, that's the way they would have spelled it. That's how the Swiss spell their country. It's not S-W. Now, so you have a holding company, and these are the children, if you want. So how does it work? Well, the way it works is, okay, you are buying the shares of HSBC. You know that, okay? But this holding company, what they do, the assets that they have actually is the equity of the subsidiaries. I mean, that's how they maintain control, because I own you. You are a wholly owned subsidiary. So I own you. I own this guy here. So the holding company has all the shares, or a majority of the shares. So I own you. And they own the private bank. Now, so a holding company, it doesn't really do a lot, except it is holding the shares of the subsidiaries. So that leads to a number of interesting observations. So this is called HoldCo for short, HoldCo. And down here, these are all called OpCo, operating companies. Okay. First of all the work is done at this level. And when money is made by the OpCo. Sorry, the HoldCo doesn't make money. Number two. Okay, so number one, all the real work is done at done by the OpCo. And number two, all the cash flows are collected through the OpCo. Okay. Number three, all the real assets they sit within OpCos. Now, so this is, I'm just telling you, this is generally, 10 times out of 10, this is how a big organization, how it functions. So what is the HoldCo, holding company discount then? Well, it is this. So if the value of this is equal to X, and the value of this is A, and B, and C, and D, the HoldCo discount says that X is not equal to A plus B plus C plus D. It is not. In fact, it is smaller. Okay, it is smaller. So that is, there is a, in other words, there is a discount when you look at it. Now there can be a number of reasons, and I have listed out some of them. In fact, they're right above. So I was talking to the other class. It could be that the free float has some limitations to it. It could be because of tax inefficiency between you know, the companies at the opco level, the way they pay tax, and then you know, when it's translated upstream, there can be you know, taxation differences. There can be admin costs associated. I mean, you're talking a big organization. Sometimes, you know, excuse me. ICBC, I heard, has 500,000 employees. I mean, that's a lot of admin. Okay, it could be also lack of control. So what I mean by that is, you know, the opcos can be running very well, or maybe they're not. Okay, but the opcos do not listen to the holdco as much as they should. I mean, that happens sometimes. Okay, so the opcos are almost so if the holdco doesn't have complete control of the opcos, then obviously we're gonna discount, because it may not be worth as much as this if they don't actually listen to you. You meaning you are here. Okay, so for all these reasons, we sometimes get this holding company discount. So it could be because of liquidity. Yes, it can be, but the holdco usually has comprehensive business. Well, it doesn't. It doesn't do much, as I said. Its main business is to control all the underlying businesses. Okay. Okay. Now, here's an interesting one. Q6. Because of time difference, ADR usually trade 24 hours later than Hong Kong exchange. Does that mean investors in the US can monitor the performance of the same stock in Hong Kong exchange and then decide if it's better to long or short? I notice sometimes the price of ADR and local stock affect each other, not just local stock price affecting the ADR. The ADR can affect the local. Well, what kind of information can we get from this kind of phenomenon? Now, you don't have to think of this in a very complicated way. Okay. Okay, I'm going to draw something. You know what that is? You don't know, right? It's not a pineapple. This is the world. Okay, this is our planet. The planet is rotating, is going round and round and round. And if you have difficulties understanding the ADR market, I would advise you just to take a step back and think of the FX, the foreign exchange market. Now, that one is easy to understand. If you trade dollar yen in Asia, it is the same dollar, same yen. If you trade in Asia, or if you trade in Europe, or if you trade in the United States, but there is a timing difference. There's a timing difference. You know, it's funny. A lot of currencies, and I think the Australian dollar is an example. A lot of currencies, during their own market hours, they sometimes they don't move a lot. They don't move a lot. The amounts can be bigger, so the transaction volume is big, but they don't move a lot. But then they move when Europe and New York comes in, even if it may be on smaller volume. But anyway, now, so if you have problems understanding the ADR market, you can equally think of FX, because it really is just that. Okay, the stock market. Let's continue with our HSBC example. Okay, so HSBC trades in Hong Kong. Now, this question is not exactly correct. It's not 24 hours later. It is not. It's more like 5.5, and you'll see why I put 5.5 in a moment. Okay. And you may be thinking that okay, so okay, let me explain what happens now. Okay, so I'm going to use Hong Kong time in all cases. Okay, so this is a local time. So in Hong Kong, I draw a timeline. So Hong Kong time at I think 9 a.m. in the morning is when the market opens, and it trades until 4 p.m. Now, actually, there's what we call after hours trading. Okay, we'll get to that in a moment. But let's just say that we will try and make it simple, and then we add more and more adjustments. So it closes at 4 p.m. now, Hong Kong time. Okay, but the ADR market in New York opens at 9:30 a.m., which is 9:30 p.m. in Hong Kong. So 5.5 hours later, so this is now 9:30 p.m. in Hong Kong, or 9:30 a.m. in New York. 9:30 a.m. New York. So this is when the ADR market opens. And this market trades until 4 p.m. New York time, which is 4 a.m. Hong Kong time. Okay, so 4 p.m. in New York. So all the times are Hong Kong times except the ones in bracket. So you have active trading in Hong Kong, in the Hong Kong market, and this one is called 005 Hong Kong, and this one is and in the US they use alphabetical codes. I think it really is just HSBC US. That is the ticker. Now, I can say two things about this. Number one, there is actually a gap where the market is not trading, or there is a gap where you are unable to buy any kind of HSBC shares, either in Hong Kong or in New York. Even if there is after hours trading, I don't know until what time it lasts, and there's a gap here. Okay, so there's no overlap, in other words. All right. So if you are thinking, well, this is the closing price in Hong Kong, and then when the New York market opens, I will just watch the closing price and determine if it is good or not. Well, I mean, look, you can do that, but I tell you, if something happens during these 5.5 hours, and quite often things do happen. I mean, the world is turning without stop, and now we have a war in Eastern Europe, so anything can happen in that 5.5 hours. Then the price here can and will change from the price that you saw 5.5 hours ago. So if you think that, oh, So now I am here, so I can watch the closing price in Hong Kong and I make a decision. Well, that's neither here nor there. You know, stock prices are martingales and they react instantaneously to information. Just because your trading has now moved from Hong Kong to the other part of the world, it does not stop prices from jumping up and down. Okay, so I don't think you can just watch the closing price in Hong Kong and use that as a basis with basis for investment without considering what has happened in between, for example. Okay, so that's the first thing to say. Now the second thing is some people are wondering, well, can I arbitrage between these two markets? It's kind of hard because in order to arbitrage two markets, A and B, I think one of the requirements should be that they are open simultaneously. So you buy from one market and immediately you turn around and you sell in the other. Now you can see these markets do not overlap as far as I know. What you can do, is if you think of now HSBC shares also trade in the United Kingdom. All right. And I have a diagram here. So for the United Kingdom, maybe you can. So let me draw it again. I don't know exactly when they open in the UK, but so now I'm going to use UK time. Okay. So let's say they open at 10 a.m. I don't trade UK stocks very often. Okay. So let's say UK time, London time. Okay. Let's say they open at 10 a.m. and they open and they close at 4 p.m. But the UK is 5 hours ahead of New York. So when New York comes in, so 9:30 a.m. in New York would be 2:30 p.m. in UK. So oops. So this is the New York ADR market. So in UK time, so the market will be open around 2:30 p.m. This is UK time. Okay. So New York time will be 9:30, as I said, 9:30 a.m. New York, and then all the way to 4 p.m. New York, which was 9 p.m. London. Okay, which is why, by the way, and I just say this for interest, a lot of the hedge funds are in London, because if you live in London, you practically can trade the three markets. You almost can. So you trade the Asian market. So when you wake up, if you wake up early in London, if you wake up at 7 a.m., that would be 2 p.m. In Hong Kong. So you can still trade the last couple of hours of that session, and you trade all the way to 9 p.m. in London. I mean, that's still pretty civilized. Okay, you're still talking about daytime hours from 7 a.m. to 9 p.m. You just about can do that. But my point to you is during this critical period, London and New York will overlap. And here there is then the window for you to arbitrage if the prices are different. Okay, so you can buy from one market and sell in the other market simultaneously. This window, by the way, also happens to be possibly the busiest time for FX trading, because that's when both London and New York are open, or when London or when the US and the European markets are active. Okay, now we can have a look at a simple example of ADR, and let me show you this. I'm going to go to Google. So I want you to have a complete understanding. So I'm going to go to Yahoo Finance, always reliable. And I'm going to look at HSBC. Now, so I'm going to pick the first one. This one is the ADR market. So this is the American market. I'm going to click on that. And I think the market was not even open yesterday. As you can see on the left-hand side, is at close on Thursday, April the 14th, at 4 p.m. EDT is Eastern something time, 33.94. Okay, I'm going to write that down. Okay, so ADR close April 14 close, US dollars 39 what? So 33.94. 33.94. Now, so if you look at it from so now we don't talk about the UK. Let's talk about Hong Kong. So Hong Kong. So if you talk about Hong Kong, then you are so this is Hong Kong, 10 a.m. to 4 p.m. So just now I told you the price at which HSBC closed in New York, 33.94. Remember that. Okay. Now, keep in mind, I said there is a gap between Hong Kong close and US ADR open. There is a gap. Okay, but never mind. When you have a very, very boring market, and Thursday was a good example of a really, really boring market. Nothing much happened. It's just the last trading day before Easter, and everyone was just planning to go home and just want some peace. Now I'm going to look at the Hong Kong stock. So this one closed at 53.25. Okay, I'm going to write that down. So 53.25 Hong Kong dollars. And let me just do a quick calculation. Okay, now, so this is HSBC in Hong Kong, April 14 close. So this price closed 5 hours or 5.5 hours earlier. Is everyone okay with that so far? This will really help you. And I know a lot of you, would have ambitions to be in the funds management industry or asset management. This is useful stuff to know, okay? I have said 1,000 times, it's not about passing the course. Forget the course, okay? It's very rare that people fail. It's about me sharing with you as much as I can so that you go out there, you stand up and be a good, confident finance professional. One more thing I want to look up is the US dollar, Hong Kong dollar exchange rate, which is normally around 7.8, but it's not exactly. So 7.84. Okay, 7.84. Now, one thing to emphasize is that the closing price in Hong Kong, which was 53.25, it doesn't have to be equivalent to the closing price here, because as I said, within this 5.5-hour gap, and certainly during New York trading hours, there's constantly news feeding into the market, and prices can change and they can adjust. That's what markets are for. But anyway, let's take a look at this. Okay. Now, so one ADR of HSBC is fungible to 5 shares. Okay, five Hong Kong shares. Okay, HSBC Hong Kong. So you do the calculation then. I'm telling you that if you take Hong Kong dollars 53.25, you multiply that by 5, because one ADR is equal to, now it doesn't have to be 5. Sometimes it's 1 for 10, 1 for 15. But in this case, I know it's 5. So you multiply by 5, and then if you divide that by 7.84, you should get the US equivalent. Like I said, okay, let me just calculate that. So 53.25 times 5 divided by 7.84 is 33. Okay, this is US dollars. This is Hong Kong dollars. Is equal to US dollars. US dollars 33.96. So you can see it is very, very close. Close enough to make any talk of arbitrage completely meaningless. And the 53.25 is the closing here. And the American equivalent is the closing here. There is no reason why they should be the same. The fact that they are so close, it means that the market was probably quite uneventful on that day. Well, I mean, it's not exactly completely motionless, because if you look at, so I mean, this is on that day, so it is kind of moving up and down a little bit, not really very much. All right, so I hope you guys are now far more comfortable with the ADR concept. I wanted to spend a lot of time explaining to you. So it is not really possible to arbitrage some ADRs. It depends on the market. If it's an ADR from Hong Kong, or it's a H share of a Chinese company, and then there is an ADR in New York, then no, I don't think it's possible, okay? Because it's a time zone problem. All right, is everyone okay? I hope this is helpful. It's a lot of talking. Now, question 7. I noticed Dingdong Logistics just announced to issue new shares. So are these primary shares? Yes, the key word is new. So if the shares are new and they've never traded, never been sold, never been transacted, then they are new shares, primary shares, and they will, well, they will do two things. They will dilute ownership, number one, and number two, they will bring in new money, new capital, new liquidity. So if this is what it looked like before your balance sheet, issuing new shares means the equity base expands, and there's new. So I'm referring to, yeah, the right hand side and then the left hand side of the balance sheet. New shares, expanding the equity side, and then bringing in new money. And normally, yes, when they do that, they are using it to fund something. You can actually turn this around, turn this observation around and say that, you know, when a company issue new shares, they are sending the market a signal that, you know, they got something planned, either an expansion or a new business or acquisition of a new business. Okay, sometimes they're not specific, and all they ever say is it's used for working capital. I really think that's a polite way of telling you nothing. Okay, it's for general working capital purpose. How many times have you seen that? Okay, doesn't really say much. Okay, now question 8. This is worth going through in the lecture. So these questions inspire me to talk about, you know, the key components of what we've done so far. The first mentioned rights are trading separately with stocks, and the term X rights refers to shares that are trading but no longer have rights attached to them because they have expired. But if rights are trading with stocks separately, no rights attached to them in the first place, why do we need to create the term X rights? Okay, there may be a slight misunderstanding of rights issue and the way it works. X right is something that applies to all shares, or all the rights, I should say, all the rights, and it is a time-based. It is a time-based event. You know, it's temporal in nature. Temporal. That's another way of saying it's time-based. Now, if you are confused, bear with me for 5 minutes, okay? The way it works when there is a rights issue, let's say it is 5 for 2. Let me do it here. So let's say you have a rights issue, a 5 for 2 rights issue. And rights issues have been very popular with especially banks. Banks in the last decade and a half, they've done a lot of rights issues. Practically any bank you can think of, HSBC, UBS, BNP, Standard Chartered, Deutsche Bank, SocGen, they've all done it. Okay, now, so imagine that the share price right now is let's say $10. Okay, and then the rights issue gives you what are the rights? The rights is, you know, for every 5 shares every 5 shares that you own, you can buy 2 more at let's say $6.50 per share. Now I'm making these numbers up, but they look fairly realistic and reasonable. Okay, so for every 5 shares that you have, you can buy another 2. Now the way it works is you can think of like a cinema ticket. You know how a cinema ticket, there's like a dotted line, and then you tear off the other bit, and then they let you in. But then you still keep this part. So if you want to go in and out, you can do so. Now, so this is like the 5 shares, and then these are the 2 rights. So if a company announces a rights issue, okay, so I'm just trying to give you a very quick summary of the timeline of events. So when they announce a rights issue here, so normally there is a period of time. So here is when the price is equal to $10 right now. Okay, it's equal to $10. There is a period of time, 4 to 6 weeks, where you can decide whether you don't have to answer right away, but this is called the X rights date. X rights date. So after this date, even if you hold this piece of paper, it's useless, because you have to tell them before. Well, you can wait up to here if you want to. You have to, but you have to tell them before the X rights date that hey, yeah, I want to carry out, I want to exercise my rights and buy 2 shares at $6.50. Okay. Now there's a lot more you can say about this. But I think the person asking that question may be a little confused if they think that there are 2 types of shares. There are those that have rights and those that are X rights. No, the rights themselves are subject to a timeline. Okay, so after the time has passed, it's so this is when the rights, or when the shares have gone X rights. So this, prior to that, is called cum rights, C-U-M, cum rights. Okay. So what does this all mean? Now, so the good way to talk about this is, well, if you are here and you are a shareholder, what are your choices? Well, choice number 1 is do nothing, which I think is very silly, because if you do nothing, then by the time, when you reach the X rights date, you haven't gained anything. The minimum you can do is to sell the rights. Okay, sell the 2 rights that the company has given to you. Sell 2 rights. And number 3 is you can choose to exercise the 2 rights. Now there's actually a number 4. You can even buy more rights. You can buy more from others if you want to. In fact, there is a number 5, which is you sell which is combining number 2. You sell the 2 rights And then when you, after you sold, you use those two rights to buy more shares. There's a name for it. It's called swallowing the tail. You don't need to know that, but I just throw that in for your interest. Swallowing the tail, or tail swallowing, I think TAIL. So anyway, okay, now on the pricing, I'll tell you what would happen. So let's say the shares are trading at 10. So if you look at this from the company's point of view, so here's a company, and the company only has 5 shares. It doesn't matter whether it is 5 shares or 5 billion shares, just 5, okay, 5 shares. And the valuation is now, so the value is $50 right now, right at this point in time is $50, okay? And what we are saying is, well, we want to sell another, or we want to raise an additional amount of money by issuing 2 new shares, which will attract $13, which is 6.5 times 2. Now, because this is the subscription price, so I know what's coming in, okay? So this is the old value, and old number of shares is 5. The new value is 50 plus 13, because that is all just cash, which is equal to 63. And the new number of shares is 5 plus 2, which is 7. So the new share price, therefore, is new share price is equal to 63 divided by 7, which is $9. Now this will happen, ladies and gentlemen, almost instantaneously. It doesn't happen here. It will happen here almost right away, as soon as they announce it. And the name for this is the TERP. Do you know what TERP stands for? Anyone? Trying to give away some participation credit. Who knows what TERP stands for? The theoretical fixed rights price. Someone wanted to speak?
Nothing.
All right. Sorry, I beat you to it. So the theoretical fixed rights price will be $9. So what is the term? Well, it is a kind of theoretical break-even, taking into account your previous value or the current value of your shares, and then what you plan to add, you know, by way of cash, and the number of shares that would involve. So when you divide the new shares, sorry, the new value by the new number of shares, you get this theoretical fixed rights price. Now I'll go one step further. There is a big illusion out there, and I really I really hope that you guys will not suffer from that, because that is what will set you apart as a professional and not an amateur. Okay, there is a real misconception out there that if you have 5 shares and each share is worth $10, and now I sell you another 2 and I'm selling them at $6.50, then wow, I made $3.50 profit. No, you haven't, and you won't. Okay, I'll tell you why. So just now I told you that the theoretical X rights price is equal to 9. Let's just say that by the time you get here, after the X rights date where you cannot exercise the rights anymore, let's just say the price is 9. Now, I know it doesn't have to be, but let's just say it is. Okay, we're always keeping in mind, the concept of the share price just being a martingale. So I got no clue where it'll be, but let's just say it stays here. Now, what does that mean? So P&L, you had 5 shares at 10. Now these 5 shares, the price has gone down to 9. So your profit and loss is actually a $1 loss times 5. So you have a $5 loss on your existing holdings, don't you? And then for these 2 shares, if the price does climb, or well, it actually dropped, it dropped from 10 to 9. But if you manage to buy 2 shares at $6.50, then you have a gain. You have a gain of $2.50 per share. And since you bought 2 shares, you have a gain of $5. You haven't made any money. You haven't lost any money. Which is why this theoretical X rights price is so important. Okay, it's telling you this is the price at which you have no gain and no loss, and the price is supposed to converge to this level. All right, now I'll stop here for the rights issue, because we spent enough time digging into that. But do not think X rights is something that apply to a certain class of shares and not other ones. X right is a status applicable to all the rights that have been granted when there is a rights issue. All right. By the way, you can now you can sign your attendance between now and 10:30, I think. So please go into Blackboard and feel free to sign your attendance. Okay. Maybe I'll give you a minute or 2. I just need to take a short break. Okay. Let me. Okay, go ahead. Go ahead.
Okay, sorry, I'm still confused about the X rights. Do you mean before the X right date, the right and share can be treated together, but after that date, we can treat the rights separately? And I don't know how to treat the rights separately. What does that mean?
Okay. I'm sorry if I spoke too fast. That's not what I meant. Okay, there are only 2 dates that you need to worry about. There's the announcement, ENNOUNCEMENT, announcement, the rights announcement date. So let's say we announce them today. Today is April 16. And we're going to run them for 1 month. So this is the X rights date. X rights date. or the expiry, if you want. That's a word that is frequently used. Okay, now are you okay with this so far?
Yes.
Timeline with 2 dates. Now, in between, in the next 30 calendar days, you can do a number of things. What things? You can do all of these, which is to say, you can do nothing. In the next 4 weeks, do nothing. Okay. In the next 4 weeks, you can sell the rights. You can sell the, now, if you sell them to somebody else, then yes, that person will take your rights and they will start trading them on a standalone basis. In the next 4 weeks, you can tell the issuer, I want to exercise. In the next 4 weeks, you can buy more rights, but whatever you do, Shufan, whatever you do, whether you buy or sell or exercise, those rights cannot be exercised anymore after this date. Are you with me? Are you with me now? So you can do all
Yes.
of those. Yeah, you can do all of it. Let me, can I do a copy paste? Oh, yes, I can. I really like Microsoft One. I mean, I shouldn't be advertising that here, but I think it's pretty cool. They've taken the idea from Samsung and they have improved on it. So you can do, whoops, you can do all of those things during this period, all of them, but you cannot do any of it after this point in time. Is that okay?
Does
Is that yeah.
Yes, just one more question. If I sell my 2 rights to another investor, does that mean that they can buy the, if they buy my rights, they just can buy the shares at 6.5 this price per share?
Correct. But if
Okay.
yes, that's a short answer. But if you sell your rights to Mr. X or Miss X out there, that's the last time you will hear from them, because once they buy your rights, then they can exercise on them, and they will be getting new shares from the company. So they don't need to talk to you about that anymore. The shares will come directly, brand new, from the company. Is that okay?
Yes, thank you. And I have another question.
Sure.
Sorry, I still don't understand what is holding company discount.
Okay, no problem. Give me a second. Okay, now, oh, by the way, I shouldn't have to say this, but if there are people who have turned up for the class for capital markets, there is no class this morning, and you will find Blackboard attendance access only if you belong to the FA tutorial. Okay, so I'm getting people sending me messages on the chat box saying, hey, I can't find it. If you can't find it, it means that you're not belonging to this session. Now, regarding the holding company discount, okay, you understand, Shufan, I hope, that you understand how a big organization operates. Is that okay with you? So you understand there's a holding company up there, and it really is called HoldCo, a holding company, and then they control all these are called core businesses, CORE, core businesses. So they control these core businesses, these operation companies, one level below, by being the majority or the wholly owned shareholder of these opcos. Are you okay with that idea? That's
Yes.
okay. You're okay with that, and you are also okay with the theory that the value of X should be now. So like I said, so these companies, this company holds the shares of this and this and this and this. So, okay, I wasn't being completely precise, but X should be the value of okay, I'll be completely precise. If I call this Y, Y is the amount of debt, and Z is all the assets they have. Okay. Then Z should be equal to A plus B plus C. Now that's a more that is going down to further detail. So Z should be equal to A plus B plus C plus D. Okay, but Z minus Y is equal to X. In theory. Okay, so if you then develop this equation further, so X should be equal to A plus B plus C plus D minus Y. It should be. But what we find often is that X is actually less than that. Now that is a so-called discount. Now never mind the reasons. Shufan, are you okay with what I'm saying up to this point in time? I'm just describing it.
Yes.
Yeah. Is that okay? Is that what was confusing you?
No, until now it's okay.
It is okay. Well, that's
Yes.
it. That's the so-called holding company discount. And all I did was I went further and I tried to explain to you why that sometimes happens. And it's for these reasons. Okay, so even if you don't understand the reasons, if you are okay with this, then you understand what a holding company discount is. It's an observation about this.
Okay, I just don't understand the reasons.
The reasons is that hold on. Now, so without diving into the details, you have to understand that these are big organizations, and what you frequently find is that, and it happens all the time, all right, $1 here, $1 here, $1 in A very often does not translate into $1 in X. So, but by the time you have taken into account all the regulations and accounting and tax, and some of these subsidiaries, you know, may be actually overseas, for example, okay, and you take into account all the FX, foreign exchange discrepancies. When you have these values, and when you start going upstream, and you feed them into the parent's balance sheet, $1 does not end up being $1. That's reason number one. Okay. Reason number two. Now, these companies can be very, very successful companies sometimes. Okay. And they can have very good valuation on their own as standalone businesses. Okay. But depending on the relationship between the parent and the subsidiary, sometimes this is not fully reflected in the valuation of the parent. You imagine there's a parent, but the subsidiary does not always listen to the parent. So the parent has some good ideas, but the subsidiary doesn't listen to it. I mean, that can happen. That happens. Okay. Then what are you going to do? Well, I'm not going to buy these shares at $10 a share because you guys don't have complete control of the guys underneath. I'm going to pay you $9.50 because I worry about whether these guys here will listen to you. Are you with me?
Yes.
Yeah. So, this is why finance is so interesting. There's a theory, but in practice, when you go into the practical world, every single day you are observing how the theory breaks down. You still need the theory, you do, because some of them are arbitrageable. So you need the theory, but you also need to relate it to practice and say, okay, is this theory holding up? And if not, can I take advantage of it? If I can, how? If I cannot, why not? Okay. Is that okay?
Okay,
with
thank you.
Yeah, you're welcome. You're very
Yes.
welcome. Yeah. Yes.
Yes, but my last question is about additional tier 1. Because during the last tutorial, you said it's bound. So, but it's actually preferred stock. So, I just want to ask, which part of balance sheet it belongs to? Does it belong to the debt part or the equity part?
I think neither.
Okay.
No. If you look at this, that is why it's called a hybrid. That's why it's called a hybrid. AT1, strictly speaking, is well, look, I guess it's, let me say this, it is closer to equity than it is to debt, because it is capable of being converted. So when it is converted, it really it fully becomes equity. But before conversion, it does look like fixed income. I think the way to think about it is not to say, is this debt, is this equity? It is AT1. So AT1 is a special class of instruments which behave like bonds, but can one day turn into common equity. That's the way I would look at it.
Okay, thank you.
Okay, yeah. Now, no, you're welcome. Let me keep going. We're up to question 9. Okay, now question 9. Now, if you have to go, please feel free to do so. Maybe you're busy after 10 o'clock. But sign your attendance, please. Okay. Now, about the rights issue, Professor mentioned there are always odd numbers, but I still don't quite understand. Can you explain? For example, 12 to 5, 12 for 5. What is the rationale? Okay, it's very simple. Now, I made an example, 5 for 2, and 12 for 5. I have seen some very, very funny configuration. like 17 for 3, or 9 for 2. Okay, now X for Y. That means if you hold X shares right now, you are entitled to buy an additional Y shares. It's not really about odd numbers, even numbers. The only requirement that X is not divisible by Y. If it is, it's not really meaningful. Now, what do I mean by that? You wouldn't do a 10 for 5. I mean, you can, but this is the same as a 2 for 1, isn't it? Except you are now lifting the requirement higher. You wouldn't do a 4 for 2 because a 4 for 2 is equal to a 2 for 1, or you wouldn't do an 8 for 4. 8 for 4. So you would do something where it's not divisible. Otherwise, you know, it doesn't, it looks funny, and it doesn't really make sense, and it's going to end up confusing people. Okay. Now, what is why is now getting on to question 10. Why is compensatory open offer counterintuitive? I want to just go back. I think it was in lecture 3. Now let me bear with me a second. I think it was lecture, because I want to find the exact point. So that would be March 26. Just give me 1 second. Now, the thing to say, first of all, is that open offers are quite rare. I'll tell you now. Open offers do not happen, at least not in Hong Kong. They're not really that common. Li Ning did one, I think. But open offers are not common, and compensatory open offer is even more uncommon. So I wouldn't worry too much about these. But what this is supposed to do is, I mean, using that example earlier, if I offer to sell you 2 shares at $6.50, now I'm talking about open offers. Okay, so you have the right to buy 2 shares at $6.50 now, but the difference now is you can't sell. You can't sell your open offer. So take it or leave it. It really is. And if you don't exercise, actually, the broker can then get your rights, and then somebody else will be allowed to buy those 2 shares. Now, a compensatory open offer is, if that somebody else, let's say, ends up buying at $8. So they said, yeah, I want these shares and I'm happy to pay more. So I'm bidding it up. So there's a $1.50 difference. And the company will actually refund to you this money to compensate you. And he mentioned it is counterintuitive. You can see this person was very, very careful listening to, she was not only reading the lecture notes, she actually listened to the lecturer, and she's asking, why is it counterintuitive? The reason it is counterintuitive is that if you have these open offers and rights issues or compensatory this and that, well, you're trying to raise money, you need cash. So what is the point of raising a whole load of cash and then giving some of it back? That doesn't seem to make sense. That's what he meant by counterintuitive. Okay. Now, question 11. About the question I asked in the tutorial this morning, how come the investment banks not just buy the shares back from the investor who sell the shares so as to manage the price level? From my understanding, if the issuer issue additional 15 million, then it will increase the supply, which will drive the price down. Okay, now this is a frequent misunderstanding of green shoe because you have not increased the supply, you have increased the demand. And let me explain. And this is important. This is important for you as someone who is about to join the finance profession very shortly. Now, if this is the issuer and this is the iBank, you have to understand that everything depends on the IPO. This is the date of birth, isn't it? So there are things that happen before it. There are things that happen after it. This is the actual IPO date. So a lot of the, what we call over allotment, actually it happens before. And then exercising the green shoe, if it is exercised, happens afterwards. In fact, 3-4 weeks afterwards. Exercise green shoe. Now, so let me explain then what happens. So the issuer will issue 100 million shares. And I really mean that. They tell you in a prospectus, 100 million plus 15% green shoe. I know that, okay? But on the IPO date, only 100 million is available. So this is the supply, strictly speaking. This is the supply on IPO date. Now the demand, A, B, C, and D, you can make up whatever numbers you want. But let's say this guy buys 40, this guy buys 30. That's 70 already. And then this guy buys another 35. What's that? That is 100. Okay, this guy buys 10. Something like that. Okay. So now the supply is 100. What is the demand? You look at the demand. The demand is 115. So we don't have 115 supply. We have 115 demand. And this is done on purpose. And 10 out of 10 IPOs are doing this. And on day one, the iBank's job is to make sure they are able to sell shares at the IPO price for not 100 million shares, but 115 million shares. Okay, that's their job. So you have created an additional demand. So where are you going to get the additional 15 million? Now, this is not really the focus, but you can have, some major shareholder just lending to them. Lending. Like I lend you my car. Lending means I want to have it back at some point. So they will lend these shares so that the settlement does not fail on day one. Otherwise, you have sold 115. You haven't got 115. Okay. And then it is up to the iBank how they are going to deal with the share return. Now, the share return can happen in two ways. If the IPO goes very well, if this is the IPO price and it just takes off, they will let it go all the way to the sky. They will let it go all the way to Jupiter if they want. Okay. People think green shoe means you issue more shares to bring the price down. Absolutely 100% incorrect. Okay, it's got nothing to do with that. Green shoe, if anything, or the over allotment is not about bringing the price down. No one wants to bring the price down. If it wants to go through the ceiling, if it wants to go to Mars, to Jupiter, let it go. Let it go all the way to the top. Okay. And then when this is called the stabilization period, as you know, stabilization period. So when this period is over, I think it's 21 days, if I remember correctly. After 3 weeks, if the price has gone through the roof, then the iBank will exercise the green shoe and say, excuse me, can you please issue an additional 15 million of new shares, and then I will give you proceeds for 15 million shares at the original IPO price, because they collected that money on day one. And then once you have issued, the iBank will just pass it back. Okay, so shares in, shares out. Now, the other way is when you do not issue the green shoe, it is because the IPO didn't go so well. Maybe it was rising and then it starts falling back to earth. So before it gets too embarrassing, defend the IPO price. That is the job of the trading desk of the lead manager. Defend by buying here, so it goes up again. Shit, it goes down. Buy again. Okay, it goes up a bit, goes down. Buy some more. Okay, until you have exhausted that 15 million of firepower, and hopefully it will start doing this as it did the Prada case. Okay, that is the proper way to understand green shoe. Now, yeah, so I think I have explained and I have turned this question around.
Hi, Sam. Hi,
Hi.
Sam.
Hey.
Yeah, I have a question towards Q11, because for her question, the investment not just buy the shares from the investors. I mean, is this the price manipulation? I sort of feel this is legal based on her description. Investment bank try to manage the price.
Okay, my advice to you, first of all, don't look at the question. Okay, and I don't.
Okay.
I say that with due respect, because the question contains an incorrect understanding and it can confuse you further. But if you think that the iBank is equipped, EQUIPPED, it's equipped with a capacity to manipulate the price. Well, I mean, manipulation is a strong word, but this is kind of legalized. This is legal, what's the word? legal price protection. You know what I mean?
Yes.
Legal PKO. You know what PKO is? Well, there are two meanings. One is that the real meaning is peacekeeping operation. So you hear the United Nations, they talk about that all the time. So you send some troops into an area at war and you try to keep the peace. That's a PKO. The joke people make is that some governments come out and start propping up share prices, and they call this, oh, you know, they're doing the annual PKO, the price keeping operation. I think you could argue that this whole IPO process and you know, allowing for an intentional over allotment, 115 versus 100, and then therefore allowing the iBank to have that window to buy back from the market if they want. It is a form of, you know, legalized price protection. You could say that. Sorry, Zhongyuan, I don't know if I've answered your question.
Yes, thank you. I
Yeah.
see.
Okay, now I've taken enough of your time. I'll just very quickly, I want to just draw your attention to, this is actually going back to 3T. There are some slides. You are very welcome to go there to have a look, and let me know if you have questions. We still have 7 days, and you have the whole day ahead of you today, whole weekend, long Easter weekend. When you, in the course of your revision, if something is bothering you, you can still let me know. Okay, that applies to you guys and also the people from the other class. You are from the FA, right? Yeah, the FC class. Now, clawback is something you should know what it is. I'll leave it to you to read this and what are the normal parameters. There are actually some exceptions, and I will, for your interest, I'll talk about these, you know, when we get another chance. But there was an exception with China Merchant, very interesting, and there was an exception with Zhong'an. I think we can discuss these later on. And in 4T, let's see if there's something I want to cover in 4. So we talked about short selling, so you know about all that, and we talked about bank capital, or, you know, balance sheet structure, bank capital, and AT1 and COCO. So just a very quick review. Remember, we had these, I gave you this data, and this is a write-up on one specific deal that went very well. This one. This was the AT1 with Bank of China some years ago, paying a 6.5% coupon. Weighted voting rights. We didn't have. I'd love to talk about this some more after the midterm. There are things that are worth knowing about WVR, but you should know at least what it is and how it works. And I'll tell you, and there are some examples of that. In Hong Kong, there's Xiaomi, Meituan as well. Pay some attention to what WVR is and what are some issues surrounding it. And like I said, you know, I would be happy to discuss that with you again after the midterm and give you some extra information, which may not be examinable. And then for this week, for 5T, so there were some slides. I'd like to draw your attention to. Not on this, so I already showed this. Slides related to different listing mechanisms. So, primary shares. You should always understand when we talk about primary shares, we are talking about new shares, shares that have never existed. You are really turning on your printer, and then you print new shares. Now, primary shares will invariably cause dilution in ownership unless you also participate. And the rights issue is a prime example. Okay, so primary shares can happen in a primary offer. That's basically the IPO. But there is this thing called a secondary offer. Now, that is also known as follow-on offer. So this is when a company is already up and running. The IPO has already been done. You can only IPO one time. But whether it is an IPO or it is a secondary offer, you can sell new shares and existing shares at the same time. So be aware of that. That's why I put it in matrix form. I hope that makes it a little easier to understand. And then primary versus secondary listing. Now, these things, we will continue talking about this. As I recall, and I don't mind mentioning that now, as I recall, and I will confirm this, I think even when you come to take the final exam, the content or the concepts behind the final exam, they are building upon the first half. So we're not going to just do a copy paste and ask you the same questions. Okay, so the weight in the final exam, the weight of the first half will be a lot less. But in order to understand the second half, you have to understand the first half. Okay, so we'll come back to these topics again. We'll revisit them. I'll make it interesting. Okay, is everyone all right? I've taken enough of your time. Look, it's when did we start? 8:30. So I've taken 2 hours and 10 minutes of your time. Thank you, everyone. Okay, there's one last question from Tang Di. Green shoe will not be exercised if the price performance is bad. Correct. What can happen is show that here. Here. Oh yeah. So what can happen is in a case like this, right? You issued 100, and but you sold 115. Let's say this investor is nervous, and 10 million shares is a lot. That's 10% of the official size. So they sell. So investor D for dog, D sells. And as a result, it puts a lot of pressure on the price. So iBank decides to buy back the 10 million shares at the original price. Let's say $10. Okay. So they are trying to protect, as I said, they're trying to defend the IPO price. Then if after that the price takes off again, then you will end up exercising green shoe for how many shares? How many shares? I am asking you the answer to the question of 15 million minus 10 million, 5 million. So this is a partial green shoe exercise. That is also possible. But if D sells 10 million, and suddenly C gets nervous, and out of 35, they sell another 5. Then iBank will have to buy it back from them. Then they have used up all their ammunition. Ammunition. 火药是吧？堂弟, are you okay with that? 火药. Is that okay with you? It says okay. All right. I'm glad. I'm going to let you go. And I wish you a very nice Easter long weekend. And write to me if you have any problems. So we've done a lot this morning. All right. So we went through this entire question set, which I think is worth it. And we also had a look at your midterm, and there are parameters on that. Please observe them carefully. And oh, the other thing, I really need you to help me. Remember to talk with your teammates and come up with the company that you want to work with for your group project, and put it down here. All right. I mean, I can remind you again in WeChat, but I don't want to keep doing it. You get sick of me. Okay. So just do it, please. All right. 10:45. I have to let you go. Goodbye, everyone, and good day, and stay healthy and stay happy. Bye for now.